This is Matt Carberry, Ridgeline Financial Partners. This is Matt on Money, our March 2020 version. Well, a lot has certainly happened since the beginning of the year, and we've held out long enough, but I think it's a good time for us to give you our perspective on the coronavirus. We are very much so concerned about it. We're concerned about it for maybe different reasons than others are, and maybe what some of the news outlets are concerned about. We want to look at it from an economic perspective, but we think it's also important to look at the virus relative to other global health pandemics that have occurred over the course of time and just try and draw some sort of a comparison with how markets have reacted in the short term, how they've reacted in the long term. So we'll get to that in this episode of Matt on Money. Okay, so the coronavirus. Let's talk about the magnitude of it. If we look at past global health pandemics, specifically SARS, MERS, Ebola, the Zika virus, what we found was that the case count was significantly lesser than what has been reported with the coronavirus. We also found that it wasn't nearly as widespread, these other health related issues. And if you look at how a lot of these other viral type illnesses have transmitted throughout the world and the case count, what we found was eventually there was a leveling off. The global health community figured out some sort of a vaccination. The countries in which there have been affected people have found a way to prevent and reduce the spread. But this is much different than what we've experienced in the past. As the case count continues to grow and the amount of countries where you have affected individuals grows, it really just gives you a better understanding of the global economy that we live in. So when we think about what our expectations are for when markets will start to stabilize, it's definitely a lot different than what we've seen in the past because we don't know when that leveling off is going to occur. We don't know when vaccines can get to the places that they need to be. And until we know that, we're going to continue to experience a lot of volatility. So let's just remember that as long-term investors, like most of us are, it's almost impossible to determine the magnitude of it. It is equally difficult to determine when markets may bottom. But if we continue to look with a long-term lens, we think that we're going to be completely fine as time moves on and as we start to get some sort of better understanding of where we're at with the virus. Okay, whenever we have markets like this, incredible volatility, vast sell-offs, we look kind of inversely as what maybe the average unsophisticated investor looks at. We are looking for opportunity. Where are there places that you could take advantage of this? Again, as a long-term investor, all you have to really look at is the market as a whole and say, wow, it has sold off sharply. At the time of this video, 10 to 15% is what most US indices are off currently year to date. But are there certain indices and sectors of the economy that have sold off even more sharply? Yeah, certainly. So if you are someone with a long-term investment time horizon, if you're fortunate enough where you have stockpiled some cash and some dry powder, this could be a very good entry point for someone that is looking out over the long term. Is there more pain? Yeah, no one knows. But if we think back to Warren Buffett, who you all know, who I am a big follower and believer, Warren Buffett made a statement in October of 2008 when he came out and he said, "Buy American, I am." Now, at that point, the Dow Jones Industrial Average was around 8,600. And what happened shortly thereafter? It went down to 6,500 and change. So Warren Buffett didn't get it right. He was off by about 23%. But what he did get right, if you were a long-term investor and you stayed invested, is looking at a Dow Jones in light of the recent sell-off that is north of 24, 25,000. So continue to stay invested. Think about opportunities that may exist if you're in a position. And the last piece of advice is to think about whether you should be rebalancing your portfolio. If you had a 60% stock, 40% bond portfolio, that is out of whack. it very easily could now look like 50% stocks and 45% bonds. So if we get back to that 60-40, it involves us selling some of our bonds, which ideally have been less affected, and buying into equities. So think about those different strategies in short order. If you got cash, maybe it's a good time, if you have a long-term time horizon, rebalancing your portfolio, and most simply, continue to save into your retirement accounts and your college savings accounts, because that goal is still there. You're only going to be buying more shares at reduced values. So thanks for tuning in. This is Matt on Money. Look forward to seeing you in April. We'll most likely be talking about taxes because it's that time of year. Take care.